Hi, this is Lee Phillips. I'm an attorney, actually counselor in the United States Supreme Court. I want to talk to you for 2 seconds about taxation of trusts. Now, the living revocable trust that you set up for estate planning isn't going to have a tax issue because it's revocable and the federal government considers that to be you. You use your Social Security number, you file your 1040 just like you always did. However, where most people run into a tax issue is the living revocable trust upon the death of the individual instantly becomes irrevocable. It now has to have its own tax ID number. It has to file a tax return. And the problem with that is you don't want a trust to have any taxation. Trust taxes are really high compared to individual taxes. So, in your trust, there's going to be language. And it's going to be language like this trust must pay everything out annually or quarter annually or whatever it is. That doesn't mean that you take money out of the bank account that the trust owns and move it over into a bank account that's not in the trust, that's just in your name. It's kind of a figure of speech, let's say. What it means is for tax purposes, you take out the money from the trust quarter annually or annually. A lot of them say quarter annually because it isn't unusual for an individual to pay quarterly taxes if they're self-employed. So it says take it out quarter annually, take it out annually. That means figuratively you take it out, you transfer that to the 1040, and you pay tax on it. Now it's been taken out of the trust technically got a deduction for it, and it's over into your pocket. Even though no money actually changed places in a bank account, as far as the IRS is concerned, it's not the trust's money, you got to pay the income tax on it. But it's critical that you have a trust where you take all of the money out and don't have it taxed in the trust, but have it taxed in your 1040 or your tax returns, because the trust pays horrific taxes compared to you as an individual.